In this recording, we're focusing on financial return calculations. This is mainly for profit-making organisations. So we'll start with the formulas that you need to know for this area of the syllabus. And then we're going to practice doing some calculations, put them into practice. And then we're going to focus particularly on earnings growth. Quite a specific and quite an unusual formula in there. And it's something that comes up in various different parts of the syllabus. So it's something we're going to focus on specifically. So the formulas, first of all. Return on shareholders' funds is one that you need to know. And I like this one because it's literally what the formula says it is. It's return on top of shareholders' funds. And the return is the profit that shareholders have access to. That's profit after tax. Profits distributable to ordinary shareholders after any preference dividends have been paid. Shareholders' funds is the share capital of the business and its built up reserves. Gearing then, and hopefully these are formulas you've seen before, you could be asked to calculate gearing based on book values, so the numbers in the accounts, or market values if the company's listed. And they might ask you to do it as a ratio of debt over equity, or more normally as a percentage, debt over debt plus equity. If you're given the choice, the second of those is usually easier to explain because it gives you a percentage, like 30% debt. And the other formula you need to know is interest cover. This is your profit before interest and tax over your interest. The reason it's PBIT, profit before interest and tax, is that that is the level of profit out of which you pay your interest bill. So those are the formulas. Let's see how they get tested. So here's an example question. We're told about a company that has some debt with some covenants. Now, if you haven't heard that term before, covenants, don't worry too much. We're going to cover it elsewhere in the syllabus in more detail. It's a restriction. That's what a covenant is. It's a restriction that comes with the debt. So the restrictions on this debt is that you have to have interest cover at least 3 times. That's the debt holder trying to protect their investment. So you need to maintain profitability. And your gearing needs to stay relatively low. So it tells us how to calculate it, debt over debt plus equity, by market value, and that has to stay below 32%. Any higher than that is more risky. More debt equals more risk, doesn't it? And here are some numbers that we're going to use. So operating profit of 2.3 million, profit after tax is 1.45 million, 10 million shares in issue, each of them $1, trading at $1.96, so above their book value. And they've got $10 million worth of corporate debt trading at, what? $107 per cent? That sounds weird. Now, if you haven't seen that terminology before, that'll be because you haven't studied corporate debt. What that means is that $107 per cent, that means that for each block of $100 of the debt, because debt always comes in a block of 100, it's trading at 7% above its book value. So $107 basically means each 100 block is $107, so 7% higher. And the coupon of 6%, that means that the debt is paying interest of 6%, and that is always of $100, 6% of $100. Not of the market value, it's of the book value. Okay? And the question's asking us, has Chili Corp kept to the terms of its corporate debt? We're going to do each of these two calculations separately. So let's start with the interest cover. And that's the relevant information we need for the interest cover calculation. And there's our interest cover formula. So pause the recording here and have a go at the calculation, and then we'll compare notes. So some of the formulas, some of the stuff I need for this formula, for example, the profit before interest and tax, I'm given in the scenario. So that was $2.3 million. But I need to work out the interest. And the interest is on the corporate debt. So we are told there's $10 million worth of corporate debt, and that pays a coupon of 6%. And that interest of 6% is paid on the book value of the debt, as I mentioned. So each block of 100 would pay $6. And so the total amount of $10 million worth of debt pays $600,000 of interest. And then putting those numbers into the formula, we get to an interest cover of 3.83. And so that means that they have met their interest cover covenant. Let's now see if they've met the gearing covenant. So that's the scenario information again showing on screen. And here is our formula for gearing. And remember, this question said it's done on market value. So pause the recording here and have a go at the calculation. Right, I did the debt calculation first of all. And it told us in the scenario that there's $10 million worth of debt at book value, and it's trading at 107% dollars. So that means it's trading at 7% higher than its book value. So I'm times it by 1.07 to get to a debt market value of 10.7 million. The equity then, there are 10 million shares and they're trading at $1.96, so that's worth $19.6 million. And then sticking the numbers in my formula, I get to gearing of 35.3%. And that is higher than the 32% covenant. So they have not met this gearing covenant. And that means that the debt holders might call in that debt. We're now going to look at another type of question where instead of doing calculations, they ask you for what's the impact of a certain event on some ratios. So we're told this company's got 5% convertible loan stock. Now again, if you haven't met that terminology before, there will be more on it later in the course, but it is something you'll have seen probably in your previous studies. So what convertible loan stock means is that at the end of the loan period, so let's say it's a three-year debt, you can either convert the debt into shares or redeem it and be paid back the amount you lent the company. And the 5% means that they pay an interest rate of 5% throughout the life of the debt. So we're told these convertible loan stocks are due to be redeemed, so that means paid back, or converted into ordinary shares by the end of the current financial year. So if all of these loan stockholders convert their debt into equity, which of these following statements is correct? Gearing will increase. The PE ratio will increase. Return on shareholders' funds will increase. Interest cover will increase. Now, if you're stuck in this kind of question, a good idea is to write out the formula for each one and perhaps stick some made-up numbers in too. So, for example, with the gearing, debt over debt plus equity, just put in some example numbers to start with. And then here we're told that the amount of debt is going to decrease because they're converting these loans. And so the loans are not going to be there anymore. And they're going to convert them into equity, so the amount of equity will increase. So adjust your numbers and see what happens. Okay, pause the recording here and have a think, and then we'll compare notes. So our first statement, gearing will increase. That is not correct. The reason is we're going to have less debt and more equity. And when you've got less debt, more equity, that means that gearing will decrease. Next, the PE ratio will increase. So PE ratio is the share price divided by the earnings per share, or the market capitalization divided by the total earnings. Now, which of these would be affected? Well, we're going to have more shares if this conversion happens. The business isn't going to be worth any more money, but we're going to have a lot more shares. What do you think will happen to the share price if we're just divvying the company up between more shares? Yeah, you're right. The share price will fall because we're dividing the value of the business by more shares. So this will cause the share price to fall. And when the share price falls, the PE ratio also falls because the P on the top of that ratio gets smaller. So that's not correct. Next, return on shareholders' funds will increase. Well, the return bit, the profit after tax, that's going to stay the same, no change. The shareholders' funds, the bit on the bottom, that's going to go up Because we've got more share capital, because these equity shares have been created. So we're going to have the same return being divided by a bigger number. So return on shareholders' funds will actually go down. The last one, interest cover, will increase. So interest cover is our profit before interest and tax divided by the amount of interest. And because we're no longer going to have these convertible loans in issue, paying that 5% interest, we're going to have less interest to pay. So let's say a similar PBIT, similar profitability, or same profitability, because we can't assume anything different, and the amount of interest is less. So that's going to mean that our interest cover will increase because we've got less interest to cover with those earnings. So it's the bottom of these that's correct. Well done if you got it right. Those sort of questions are pretty challenging. So if you found that hard going, don't worry, that's completely normal. A good idea is to put some fake numbers in and it might help you.